Good afternoon, and welcome to the Winter 2025 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of training and certifications to the CRE business since 2009. We're pleased today to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using Zoom, and I'd like to address a couple of housekeeping items before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that's by design and will remain the case throughout the webinar. If you're attending by computer, please take a moment to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you would like to download them, we have just sent them through on the chat. And you don't need to have them up because we'll be showing them, but they're there for future reference and for you to keep. As always, we're reserving 15 to 20 minutes at the end for questions and answers. Please feel free to submit your questions at any time by clicking on the Q&A button on the control panel. Type the question in and make sure that you send it through by clicking on send. If at any point you get disconnected, just reconnect the way you connected initially. And if you are registered later today, you will receive an email with a link to the recording of the webinar, as well as a link to the slides. And the video will also be posted on the Linneman Associates website later today. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you. And are you in Philadelphia today?
I'm in Philadelphia. It's really cold. We're in a cold stretch, and we're looking forward to warmer weather at some point. But we're the home of the Super Bowl champions. So if anyone's listening from Kansas City, you still have a great team. Don't give up. So let's go to the first slide, Bruce. And by the way, we're going to have a number of chart slides later that I'm going to go over very quickly because I'm going to talk about them in this chart and a couple of others. So I'll go quickly through some of them later, but then you've got them for your reference later. So big question. What's the impact of the election on the economy? To be determined. It's still very early. You don't decide the winner of the game after about 10 pitches of the ball game, which is what everybody's trying to do. I think it will have a mild positive influence on GDP growth. What's mild? 20 basis points a year, which is too small to ever identify. Could be as high as 40. There'll be a bit of a negative effect happening from tariffs. There'll be a notable positive effect, particularly later in the year, from deregulation or lesser levels of regulation. There'll be, depending if the Ukraine's war ends, that actually will have a negative effect of probably 20 to 40 basis points a year on GDP. Because of what impact it has on things we provide. Most of those effects will be later in the year, but that's a big question. Will the Fed cut rates this year? And the answer is, in my view, yes. We'll come back to that. I expect 100 basis points cut this year. I don't expect next month, but I do expect, again, they're going to surprise themselves as they've done so often in the past. Is inflation over? Yes, inflation's massively lower than the headlines. Essentially, all of the inflation that makes the headlines is coming from housing, and most of that isn't even an outlay anybody makes. Will the lender strike end? Yes. There are signs it's starting to thaw. I think that'll pick up as the year goes on, especially if the Fed lowers the short-term rate. It will cause a rotation into longer lending and investments. Will there be a recession in 2025? I don't think so. Recoveries tend to last 6 to 8 years. There are no notable signs of economic excesses. And will geopolitical issues cause major disruptions this year? I don't think so. We've largely been immune to, if you go back, what hasn't derailed. The major thing that derailed was COVID. And it was, with perfect hindsight, it was probably less COVID per se, although that would have had an adverse impact, but the reactions of shutting down so much for so long around the globe, that was the source of the disruption. Go to the next. Let's take an economic status report. We've largely caught up from the shutdown. You'll see in a chart in a moment that real GDP is getting close to pre-pandemic trend, still slightly below. High Fed interest rates are slowing down autos, slowing down housing, slowing down companies that rely on lines of credit, which are particularly and short-term money, which are particularly regional banks and manufacturing. Employment still lags more so than does real GDP. And the reason that employment is lagged more than real GDP is the increase in productivity. As I said, recoveries tend to last 6 to 8 years. It is interesting to note that while the aggregate economy is larger than pre-pandemic, so that's what I mean by recovered, it's larger than pre-pandemic. 22% of metropolitan areas still have employment below 2019, and 12 of the 50 states still have lower GDPs than they did pre-pandemic. The go-go states have been Texas, Florida, the Carolinas, Georgia, Utah, Arizona, and Nevada. But offsetting that are 12 states where real GDP is below where it was almost 6 years ago now. Go to the next, Bruce. What does the new administration mean for the economy and real estate? I think real quickly, there was a discussion of national rent controls, which slipped in late while Biden was still a candidate, and continued a bit as Harris was the candidate. I think that national rent controls are off the table for apartments. Having said that, it's still a local issue. So it's not like rent controls are out, it's national rent controls. Give you a sense of the difference of Trump 1 versus Obama and Biden. 80,000 pages in the Federal Register and an annual estimated cost. These are not my estimates. These are people who have estimated them for like 30 years. It had nothing to do with the current or recent administrations, of about 250 billion as the cost of the economy annually. So roughly 1% of GDP. During the Obama years, if you jump down to Biden, it was 85,000 pages in the Federal Register and 270 billion in regulatory costs. Again, about 1% of GDP lost. You can see that Trump was about 15-20% fewer pages in the Federal Register, and a cost measured in the millions rather than the hundreds of billions. You're not going to see taxes increased. You will see some minor reductions, such as no tax on Social Security, no tax on tips, etc. Those are not big revenue losses because you only had people in the upper 40 percentile basically paying income taxes, and very few people receiving tip income are in the top 40% of the income distribution. So if you say they don't have to pay any longer, they weren't paying in the first place. And not as extreme, but similar with Social Security. Most Social Security recipients don't work, and you pretty much have to work to be in the upper 40 percentile of the income distribution. So the loss in revenue is not take the average tax rate times the outlays. It's take the marginal tax rate paid by those payers, which is very close to zero. Tariffs, just some facts. The average over the Obama administration, the first 2 years of Trump, was $2 tariff on $100 bought from overseas. The last 2 years of Trump and the first 2 years of Biden, that moved up to $3 in tariffs paid on $100 of items purchased. The tariffs were largely up because of items coming through China. They were down because of items coming through Vietnam, and there were more of them. And pretty much the rest of the world was unchanged. At most, I think when it settles out, you'll get $3 to $5 per $100, mostly imposed on China, which will be great news for the Philippines and Vietnam. Net net will have little long-term effect, though it'll have short-term disruptive effects. You're not going to see a big increase in onshoring, simply because unless it is a laydown hand to locate in the US because it's close call, you're going to locate where it's most economic. Go to the next. Borders will undoubtedly tighten. The borders during Bush, Obama, and Trump were pretty stable, in the sense that about the same number of illegals were coming in, about the same number were being deported. Net, there was some net inflow that began as illegal, but it was pretty steady. Obama was the largest deporter, but not by a huge margin. And then it skyrocketed during the first 3 years of the Biden administration, both by many more illegals and not nearly as many deportations. In the last year of the Biden administration, it went down to levels only somewhat higher than during the Bush, Obama, Trump years, as they finally reacted to resistance. What I think you're going to see is a back to the Obama Trump levels. You will have some deportations of that excess that came in that'll last about a year. It will modestly tighten low skill labor markets. You'll have high profile deportation of some felons to get headlines. It will reduce some of the budgetary strains on places like New York and Chicago and others, not to mention the border areas. I don't think it will get overdone because the majority in the House is very small, and so small that if votes come up when people are out of town, the Republicans can't carry even if they are completely together. If suddenly all illegal immigrants, and there are about 15 million of them estimated in the United States, of which about 10 to 11 million are estimated to be working, if they all got deported tomorrow, you'd have a lot of businesses on the phone to their representatives saying, now hold on. And therefore, there is a balancing phenomena there, because if Trump does want to get anything passed legislatively, he's going to need the House, and you'll lose. He doesn't have a big enough majority there. Deficits, I don't see any reason why the deficits wouldn't go back to very similar to the first 3 years of Trump. The reason I don't say the fourth year is that was a COVID year. So the first 3 years of Trump, which is notably lower than the last 2 years of Biden. It's actually notably lower than all 4 years of Biden. I don't take the first 2 years simply because those were also COVID years. So I don't, quote, grade that against him. There is no strong statistical relationship between deficits and outstanding federal debt in the United States and the 10-year Treasury yield. A couple of researchers at the Fed summarized that research recently in a meta study. It is a very, very tiny effect, not surprisingly, because we're massively over collateralized when you look at our wealth. Don't look at our current tax revenue. Look at our ability to raise further tax revenue, our wealth, our future wealth. We're massively over collateralized. And the analogy I use is, imagine Elon Musk bought a $20 million apartment building and he got a full personal recourse 10% loan to value on that apartment project. If he said, well, I'll tell you what, why don't I go to 50% loan to value on that project? Why don't I go from 3 times interest coverage to 1.05 interest coverage? It doesn't matter, because the full collateral is so extreme. The interest rate would go up a little bit only because of the hassle cost of accessing the personal recourse. And that's sort of the situation of the US. We're massively over collateralized. Doge, I would guess when it all shakes out, around 500 billion will be claimed to have been found. It'll be hard. Some of it is going to come from personnel, though there's not enough personnel. A lot is going to come from crazy programs that any large organization has. And since the US government is the largest organization, is it surprising that they've got probably more waste, fraud, and abuse? You're seeing it at USAID. I was saying that for years, I've read that USAID is largely, not totally, largely about pet projects and about trying to manipulate political outcomes in other countries under the guise of doing good. And I think you're going to find a lot of that. How much? I don't know. You're going to find some crazy programs. You're going to find pet projects that you go, why did we choose to do it? You're going to find people who have 3 jobs, especially since they've been working virtually. There is going to be an improvement in processes. People are going to get embarrassed. And when you get people embarrassed, they're going to tighten down their departments. Does anyone listening think that in Social Security, Medicare, Medicaid, there isn't at least 5% fraud, like Tony Soprano, mafia type of fraud going on? And I'm not saying it'll be easy to root out, but they're going to find and try to put in systems and so forth. It will largely be a good effort, but it's a painful effort. Such efforts are never easy. Go to the next. So this is kind of just a chart of what I was saying about border crossings, and you can see what I was saying. This is simply what I was saying about border crossings. Go to the next. And this is what I was saying about the US budget deficit. I circled the first 3 years of Trump as a percent of GDP. As I say, the 4th year of Trump was COVID, and the first year or 2 Biden was COVID. I circled the last 2 years as kind of, quote, normalized, and, somewhat lower under Trump than Biden. I would say higher than necessary, but stay tuned. Go to the next. This was the chart where I was saying real GDP, still lagging trend. The light blue is pre-COVID trend GDP. The dark blue is where we're at. The red is where we started. at the end of 2019. And you can see we've almost caught up, but we're still a little below trend. I'll go to the next. Same chart for employment. I was saying how employment is catching up. The red is where we started, the light blue is the trend, and the dark is where we're at. You can see that it has not narrowed the gap as much as real GDP. And if you say we've gotten GDP pretty much back with not getting the trend labor, it's that productivity has made up the difference. So go to the next. The economy is normalizing. This is weekly initial unemployment insurance claims as a percent of the labor force. Numbers came out this morning. They come out every Thursday. They lag by a week. They were very strong numbers. They aren't in this chart, but if they were, they would make no difference to how the chart looks. I circled the COVID window, and you can see literally off the chart. When you say people will say something is off the chart, this is it. And the reason is you would have never scaled this chart like this, but for that. You know, the 70s, around 73, 74 was a horrible period. The early 80s was a bad period. You know, the financial crisis was a bad period. They're all just little blips compared to what happened. The real point is the economy is normalized. And I said to an audience about a month ago, if I'd have told you 5 years earlier, so remember this was in January, that we were going to not allow any travel to Europe or Asia or South America unless it was essential. You couldn't get elective surgery. You couldn't go to ball games. There were no theaters. Vegas was completely, all the casinos were completely shut. All the entertainment venues in Orlando were completely shut, et cetera, et cetera. Your first reaction would be it would never happen. And I said, but assume it happened. How long does it take the economy to adjust? And I think I wrote it back in May of 2020, 4 to 5 years. And it has taken 4 to 5 years. We are largely normalized. That's not to say everything in the economy is normalized, but we've normalized. Go to the next. Unemployment rate. You see it shoot off the charts and normalized. It's still pretty low. Teens are still low. That's a good sign because teens are the first thing to shoot up as the economy weakens, and we don't see teens shooting up. That's the red. The blue is everybody. So this still looks strong. Go to the next. Labor force 65 and older, the classics, as it were. You can see that their labor force participation, men and women, had been steadily rising since the late 80s and then kind of collapsed during COVID. It has almost, still not back. It's the only group not back to pre-COVID levels of labor force participation, almost back, but the growth stopped, particularly among women. And so when you say, where are those missing workers? Those missing workers in that employment chart are heavily concentrated in over 65, particularly among women over 65. There are a lot of theories, but there's no definitive study I know saying, here's the evidence of why. And go to the next. Again, another sign of normalization. This is the percent of industries adding jobs. The red is the average. The blue is the actual. Or not, the red is not average. The red is 50%. It's just a 50% marker line. You can see the average tends to be above 50%. And in normal times, you see that period from 2012 to 2019, 60% or so. We're around that level now, kind of normalized economy. Go to the next. Couple of interesting charts just to make you realize what's going on in the broader economy. People talk to me about what is the thing to watch moving forward. I'll give you a couple of them. Big trends. This is the population 65 and older as a percent of the US population. It's growing. It's going to continue to grow. And the boom is going to continue. Longer living, mostly healthier living. Those that are healthy are really healthy by historic standards. Yes, you have a lot of chronic disease happening, but this group is the largest and wealthiest group of seniors in history of the world. They have money to spend on travel and leisure and healthcare and grandchildren and anything they want to spend it on. This is the more interesting group to follow in terms of spending patterns over the next 10 to 15 years than the younger, simply because they have the resources. Now, they may choose to give it to younger generations. To that end, how many people do you think living in those high-end student housing projects that some of you have their rent being paid for by grandma, grandpa? And the answer is a lot. Similarly, how many cars are being bought? How many phone plans? How many iPhones? All that type of stuff. Grandma, grandpa are paying for. So keep an eye on understanding this generation. It's early on. It is just now hitting the age of the oldest is of this group is now just approaching 80. So its impact on senior housing is just starting to take effect. And you're going to have a number of years to come in that regard. Go to the next. Another is when I'm born, essentially nothing was, I wasn't born in 1992. I was born in 1951. But if you take this chart back to 1951, basically nothing was spent on eating in restaurants. And as you can see, by basically 2020, it crossed over, that we spend more money eating in restaurants than we spend on groceries. I think that will continue. The grocery line will continue upward, and the eating in restaurants will go upward much faster. We've become a nation of grazers and let somebody else fix it and clean it up for me. Go to the next. Consumer confidence, the red line is average over this long period. And you can see we're slightly above average, not much above average. And again, I think this picks up the normalization phenomena. We've had some ups and downs, and it's kind of normalized in terms of where consumer confidence is. Go to the next. Small business, it's interesting. Small business confidence, if you go back and you look at the big spike that occurred in 2016, that was on November when Trump won the first time. It spiked, and now you can see it really jumped in 1 month. We had the same thing happen in November of last year on the Trump win. Otherwise, it tends to bounce around. It's high. I think largely small businesses are thankful that they will probably get a lower regulatory burden, which will help. Go next. One of the things that's fueled the consumer is the cheap mortgages that people locked in 2020, 2021, early 22. They have put a lot of spare money versus normal market conditions in the pockets of homeowners. About 70% of all homeowners which is about 42% of all households, have fixed rate mortgages of 4% or less with another 25 to 30 years to run. That's a lot of spending power they've gotten. It makes them less willing to move. They'll move, but makes them less willing to move. And this constrains the supply of existing homes for sale, which fuels both new home construction as an alternative, but more so, it fuels multifamily demand and single family rental demand. Go to the next. Single family housing, staggering imbalance. And you can see if you go back to 2002, the market of supply demand of single family was in rough balance. That is, it wasn't above or below zero. In 4 years, it got to 2 million units in excess of what would be suggested by demand fundamentals. By beginning of 2012, the shutdown of the housing industry had not only burned off all of that 2 million excess, and then for the last really 14 years, we have underproduced single family to the tune of about 3.5 million homes, or about 3.5% of the economy. If you have a shortfall of 3.5% in supply of something people really want, and people really want it, single family housing, then you will get prices rising. So when the interest rates shot up a couple of years ago, everybody said, oh, single family home prices were going to collapse. And I said, no, it was this chart that made me say no. There was a very temporary drop of a small amount, and then it went back to rise, going up. And it's this chart that's driving it. It's this chart which drives a lot of multifamily demand. And it's not going to disappear. You're not going to suddenly have 3 million single family homes appear on the market. This could take decades, and it may never adjust. This may be the new normal. Go to the next. Financial obligations for households as a percent of their personal income. The red is the average as a percent of income, which is right around 16%, runs above, runs below. You can see that what is gotten the headline is how it's jumped up over the last 2 years. If you look at the far right of the chart, well, it has gone up a lot over the last 2 years, but it went from about 12% to about 14%, which is still way below, like 4 percentage points below where it was for 20 years. So I'm not making a comment the consumer's smart or dumb or over levered or under levered. I'm just saying this is a level of leverage that they've dealt with quite effectively historically. Even though the obligation has risen, it's still low by historic standards. And I think that bodes well for the economy. And remember, one of the reasons it went down is you couldn't buy anything during 2020, 2021. So, of course, people didn't borrow as much, and they saved more, and they paid down some debt. So they're getting back to normal. Go to the next chart. This is the best estimate I can put together of real, that is adjusted for inflation, sales through brick outlets, not counting automotive. Still about 6 out of every $7 sold are going through brick outlets rather than online. The red is where it was pre-pandemic, just to help your eye. And we are above that in real terms. Remember, if it's flat in real terms, it means it's going up with inflation. Another way of saying it is it's going up slightly less than inflation, but fairly flat. Another way to view that is if you look at the period 2005 to just before the financial crisis, it flattened out, which meant it was going up at the rate of inflation in nominal dollars. And you see it again from 2017 through 2019. So I think you may be at another real plateau in terms of brick sales, but it's hardly like they've disappeared, and good retail is doing pretty well. Go to the next. E-commerce as a percent of all retail sales, not counting auto. The red is not the trend. It's just doing what your eye would do, or something like your eye would do. And you can see it was upward trend and spiked when you couldn't go buy things in brick stores. And when you could buy things in brick stores, it flatlined, but it's going to increase up. It has a lot of things that it figures out how to do each year, and more people get comfortable with doing it each year. But it still has to deal with items that are low margin, high touch. It's very tough to ship, and shipping costs are a fixed cost. And if you've got a low margin and it has to be handled a lot, that eats into that margin and makes it difficult. Go to the next. 10-year treasury should be much lower. The short-term rate should be much lower. Why? I think the 10-year treasury should be 3 to 3.5%. The Fed funds rate should be 2 to 2.5%. Why? The Fed overreacted. They panicked. After they said they weren't going to raise rates in any hurry, they raised them very rapidly, as you see here. If you look back to the 2010s, it took them forever to raise rates. I think when they told people it was going to take them, they were in no hurry to raise rates. People anticipated that. They then raised rates rapidly, wrong-footed the market, kind of tied up a lot of capital until they figured it out. If you think about, let's say we end up normalizing at a 1.5 to 2% inflation rate, the short-term rate should be 75 to 100 basis points over that. So 2.75 to 3. The long rate should be 150 to 200 basis points over inflation, which suggests a number 3, 3.5, something in that range. Way too high. People say, well, why is the rate where it's at today? I don't know the answer. I hear what people say. They're worried about deficits, but I know that historically there's no relationship between deficits. They worry about tariffs. There's no relationship historically. Whenever somebody says that the interest rate is right today, I tell them, go back then. Why was it at 3.6 9 months ago? I understood it when it was at 3.6-ish. So I think it comes down this year. Remember that the Fed, yes, has cut the interest rate on the short end by 100 basis points, but over that time period, inflation has fallen by 400 to 500 basis points. So the real short-term rate has actually gone up. So let's go to the next. Fed always is late. As I said, inflation is down 400 to 500, and interest rates have been only brought down by 100. So the real short rate remains high. Inflation's 1.5 to 2.5. And I do think you're going to get 4 cuts this year because inflation is way down. Go to the next. The main cause of the inflation was the supply chain shortage, which is the first circle, that is massively tight relative to normal. So you can see this long normal bouncing around zero in terms of excess supply, excess demand, shot up to 3 and 4 standard deviations. You got unprecedented shortages, you got unprecedented price increases. The second circle is that's adjusted back to normal. That doesn't mean prices fall. It means inflation stops. Just because inflation stops doesn't mean prices fall. The snow can stop falling, but it doesn't mean the snow disappears. That's a separate phenomenon. So you've all been in a snowstorm saying, oh my God, look at the snow, it's coming down, it's coming down. And then you say, oh, it's barely coming down anymore. Yes, but the snow's still there. That's what's going on. Those prices are not going to generally fall. There'll be some that do, but that's because the inflation rate has come back down to a modest increase. Go to the next. This is inflation measured by CPI without owner equivalent. An owner equivalent is a theoretical rent that owners pay to themselves. By the way, it's not counted as income. It's not saying, well, you pay rent to yourself and you get that as additional income. No one has ever paid owner equivalent rent, yet it's roughly a quarter of what causes CPI mathematically. And if I showed you this chart and you looked at since 2023, you'd say inflation is pretty normalized. All right, the last year and a half, 2 years, not much difference than the average going back to 2000. Obviously, there was a period when you had those shortages where it shot up, but that's long gone. Almost all the headline is being created by owner equivalent. Go to the next. Summary, year over year in January, the headline was 3%. PCE year over year was 2.1%. However, without owner equivalent rent, it was 1% year over year. And in fact, without owner equivalent rent in it, remember, which no one pays it or receives it, but it's 25% of CPI. It's basically been flat. That is, CPI is basically unchanged since April. And in the 30 years prior to the pandemic, CPI increase without owner equivalent was 2.6%. And since April, it's basically been zero. And over the last year, it's 1%. There's just no real inflation at the moment. And it's consistent. If you go back to that, don't go back, but on that supply chain chart, you'll note that not only did it adjust downward, there was a short period of where it went to an excess supply. Those of you who are landlords, you'll be happy to know that the CPI reports that you got a 4.6% increase year over year in your rents. It's not consistent with Yardi. It's not consistent with CoStar. It's not consistent with what the public companies report. It's not consistent with casual conversations I have with landlords, big and small, which is basically zero on average across the country. I have no idea how they come up with 4.6% year over year increase in rent, but that's what they report. So inflation is being massively overstated. It's all being driven by housing. Oh, and eggs. But okay, go to the next. And then I'm going to wrap up on a couple of things. This is bank excess reserves. I marked versus the end of QE1, QE2, QE3 in red. You see how it went down from there. We're still in early days of it going down. We're not even back down to where it was in the beginning of its decline after QE3. There's still a lot of money in the system. I believe it continues to come out. As it continues to come out, I think it will show up not as consumer price inflation. It's going to show up as asset price inflation, much as it did during the 2010s. A lot of money, hasn't come out much in the last year or so, but it will. Go to the next. Money supply up about 2.6% over the past year. If you figure we're growing, at about 2.5% a year. There's no net price movement, therefore. So this is still got a lot of legs. The rapid expansion of the money supply has ended. There's still a lot of money in the system, largely sitting in savings. It'll end up mostly staying in assets rather than goods and services inflation. That's why I believe the inflation is already very low and will come down at the end and will force the Fed to reduce interest rates. Go on. This is another, you see there's still huge amounts of money in the blue sitting in checking accounts and currency. People are going to use it to do primarily investment. They'll travel a bit, they'll buy some cars, but it's going to largely show up in savings. Go to the next. Oil's bouncing around normal in real terms. Remember, we're a net exporter, so we slightly benefit from high oil prices. Not every place in the country, not every consumer, but on net we do. The red line is the long-term real average, and the light blues are the markers for the high and low. We're around normal. I would expect this to come down further, probably $3-4, come down over the next couple of years as Trump policies make it a bit easier to drill. They'll make up in volume and reduce costs, regulatory cost, what they give up in price. Go next. And the government debt is huge. It's outrageous. It's been spent on lots of things that are kind of crazy, as well as some things that are quite good. The line I like to focus people on is the very bottom one. That's the debt we owe to foreigners. Everything other than that bottom line, we owe to ourselves in one form or another. And in fact, you can see that the percent of of our debt that we owe to foreigners as a percent of GDP, so that's a percent of GDP, by the way, has fallen. And it's flattened out on the other. And what's really happening here is huge holdings of government debt by the Fed, other branches of the US government owe debt to themselves. When you cancel that out, you get the middle line, which is still that debt relative to GDP runs about 60%, but that's very different than running 105%. We're massively over collateralized on this. I wish we didn't have this debt. I wish we didn't waste it as much as we do, but we can afford it. We're a very rich group of people, and just like very rich people can afford to have debt and can afford to spend things irresponsibly, so too can the US. Go to the next. And then real quick, office vacancy rates have gone flat. Leasing is showing some signs of improvement, still a troubled sector. Go to the next. Industrial vacancy rates ticked up a bit, less so for the highest quality properties. Interestingly, I think the really small properties are leasing pretty well, and the very large properties are leasing very well, and the in-between, softer but still strong by historic standards. And the supply pipeline has dried up a bit, so that will strengthen as we go through this year and next. Go to the next. Retail vacancies down. Nothing is getting built spec. Nothing is really getting built unless there's a strong tenant usage. Good retail doing quite well. Hard work, because consumer preferences constantly change. Therefore, what should be in a center constantly changes. So it's hard work, but in pretty good shape. Go to the next. Hotel occupancy, still not all the way back, long way back, but still not all the way back. And it's one of the areas where there still is pent up demand. Still got some distance to go there. I think it's a good sector looking forward. Go to the next. And multifamily rates, I've circled at the end. High and lower quality properties, pretty much the same in that regard on average. They bottomed in early 2022. They've ticked up by historic standards. They're in pretty healthy range, even though they've ticked up. The supply pipeline is emptying in almost all markets, though there are a few markets. Some of you on the phone, on the line, know where they're at. There are still some markets where the pipeline is big, but as that pipeline empties and demand remains strong, remember, this has not been a weakness brought about by weakening demand. This has been decent demand in the face of a supply spurt. So as that spurt ends, demand will pick up, and by late in the year, you are going to see good increases in rents, and I think really as you go into next year, even much better. And Bruce, I think that brings us to the end for questions.
Great. Thank you very much, Peter. As always, very interesting. A lot to think about. We've had a lot of questions come through. We have a lot of naturally multifamily folks on the line, and several have written in regarding the constraint on the single family homes supply. And how do you see that affecting multifamily in the near future?
All good. All good for multi. All good for multi. Interestingly, for the single family builders, they're getting back in price. The price increase makes up for a bit lower, they can get kind of normalized volume on higher prices brought about by the fundamental shortfall in supply. So the home builders are doing okay. And the multifamily people and the single family renter people, look, when the home price goes up faster than inflation and income, it just means you have to save longer before you can afford the down payment for a home. And that keeps people either living with their families longer or doubling up or renting longer. Not like 20 years longer, but 2 or 3 years longer. And that's a big deal. If the average renter rents, let's say 12 years, getting an extra 2 or 3 years is a lot. I don't mean they rent in the same unit for 12 or 13 years, but in their life, if they rent 12, 13, 14 years, getting that to last 2 or 3 years longer is a big increase. Right. And that's going to continue.
Great. You talked about this cohort of 65 plus being a major force. Can you give us a little bit more detail on how that's going to impact the industry? Are we talking about primarily benefiting age-restricted housing, or is it across the board in terms of housing?
So I think it's too early to say, because they're really just, and I'm one of them, they're really just moving into it, and it's uncharted territory. We just don't have a lot of precedent. We've had well-off people, we've had healthy people, but we've not had a mass population of well-off, healthy people of that age. And they're just figuring it out. I think it obviously means a lot for travel, targeted to people 60 to maybe 84, 85. I think it means a lot in terms of senior living, independent first, and age restricted first. I say first because, as I told you, the front edge of the baby boom is just approaching 80. So it's just approaching that. More seriously, as you go 6, 7, 8 years from now, you'll see it in other variants of senior, but I think it'll also affect things like student housing. You say, how they're not going to go back to school? No, but they're going to have money, and they like their grandchildren more than they like their children. And I think they'll spring for some of the student housing or continue to. It'll have an impact on all sorts of things down generationally from them. I don't know, is the villages the future of what that life looks like? And you could argue, yeah. I mean, I'm not saying for everybody, but for a mass, something like the villages, which is community creation somehow and activity creation somehow. But I think it's too soon to really know, but it's not too soon to start tracking carefully.
Thank you. What are your thoughts on construction costs, and do you see them normalizing at all going forward, or continued historical inflation trend on construction costs?
Well, as you know, we track it, and we track Turner's index. Turner's better for high rise, ours is better for low and mid rise. Neither is perfect. And these are material and labor costs. The labor part's going to continue to go up and cause construction costs to materials will run around inflation over the long term with a lot of cyclicality. And we're probably going to see the materials part go below inflation increases over the next 2 years because construction activity is going below. But labor costs will continue to push up. People keep getting more productive. To get labor, you're going to have to keep paying for the productivity increase, whether you're receiving productivity increase from them or not. Otherwise, they won't work for you. They'll go to only the ones that have high productivity. And then the wild card is neither our index or Turner's track the cost burden of state and local regs. And if you said, where is the real increase over the last 20 or 30 years occurred, it's not in steel outstripping inflation. It's not in concrete outstripping inflation. It's not even labor massively outstripping inflation. It's the burden, the costs, the uncertainties imposed by state and local regs. And I don't see that reversing.
We had a few participants write in about the private credit and debt funds that have stepped in, where the traditional banks have pulled back. And they're curious to know, do you see this as a longer term trend in real estate financing, or is this something that we're going to look back and say, oh yeah, remember when there were all these non-bank banks giving us
Well,
alternatives?
I think the non-bank banks will continue, partly because of the regulatory environment that I'm oversimplifying, but saying if I make a direct loan on real estate as a bank, it gets a higher capital requirement than if I make a loan to a business that happens to be a non-bank that makes the same exact loan. So if you did a transparency check, the leverage could be the same, but the required capital is less if I do it through a non-bank. So that kind of capital requirement, which is regulatory induced, arbitrage will continue. So in that sense, I don't see the non-bank banks shrinking. I actually see them increasing unless there was a change in the regulatory. There's a variant of that, which is, as you know, massive amounts of mezz money was raised figuring there was going to be enormous opportunities to bridge people, to mezz people, etc. And the fantasy of a 20% yield, on a 2-year loan on a great property and so forth. Well, there
Right.
have been some opportunities, but they've not been as extensive as people thought because the banks um, have been slow to foreclose. And it's very tough to compete against the banks because they have the cheapest money. Um, the mezz business has always been a business, but it's a tough business because you don't control it, the banks do. And I'll give an overly mechanical example. Let's say normal capital markets, 65% loan to value is typical. And suddenly the banks decide to do 70% loan to value. Well, they'll just wipe out that mezz lender who was going to do the 65 to 70 because they're going to lend it as a first rather than as a mezz.
Right.
The reverse is also true. When they go from 65% to 60%, the business booms, right? The business booms because suddenly people need that 5% of the capital stack filled. And there, but by the way, when the banks come back and say we're going to do 65, the gap gets right, the gap goes away. So it's a good business, but it's one that you don't really have a lot of control over. The banks have a lot of control over.
Well said. Thank you so much, Peter. Unfortunately, we need to wrap up, and so we're not going to be able to address all of the other questions that have come in. But I want to make sure everyone's aware that this presentation is a digest of what's presented in a lot more detail in your quarterly Linneman letter. More information on the Linneman letter can be found on the Linneman Associates website, which is linnemansociates.com. And as a reminder, if you registered, you will automatically receive an email link to the recording, as well as a link to today's slides in about an hour or so. And so, Peter, thank you once again, and thank you to everyone for joining, and hopefully we get some more balmy weather in the near term.
Thank you, everyone, and see you on a warmer side.
Okay, thank you.